keeping in check the greed and fear with investing is, I would say, arguably the most important part. Way more important than like what should you buy, what stocks, what is just managing the greed and the fear. Because as humans, we're going to experience all of it if you've got money invested.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt Walters here with Lee Mackey.
Good morning.
And John Martfeld.
Good morning.
We are, most importantly, before we start talking about the markets and the economy and Q1 and all that stuff, we are deep into March Madness. In my bracket is struggling. So I think I'm 14th out of 22 here at the firm. So
I think that our firm's top five is led by people who do not care about basketball.
Yep.
Don't watch basketball. Wouldn't know a terrapin from a blue devil.
Exactly.
But yet they're
my
in
total
the lead.
possible points is still decent. So, there's a chance.
So your champion's still alive is what you're saying.
I have three of the Final Four
Oh,
people.
yeah. Well, that's
the
pretty big.
two teams I have in the championship game are still alive. So
My two champions lost, so I'm out.
Yeah, you're
officially
toast.
Gone. Toast.
UNC Wilmington didn't quite make it.
No, I had Texas Tech and Arizona. I mean, you got to go outside the lines. I mean, who would have thought first time in or second time in history?
I was about to say the year that all four number ones make
Yeah.
the Final Four is not the year to go outside the lines.
Yeah.
Well, right, but now in retrospect, if I had the time
Historically
machine,
speaking,
I would go back make
Yeah.
that change.
It's an awesome time of year. We got the Masters. When's the Masters?
2 weeks.
2 weeks from now, yeah.
Masters coming up, March Madness. So for you sports junkies out there,
And then the NFL draft after that.
it's a fun time of year.
Yeah.
Yep.
Titans, number one pick.
Yes.
It will be interesting to see what they do. So, anyways, okay, moving on. So the markets. So Q1, man, lot going on. Lot going on for sure. A lot of just. I've been telling people I've been talking to, the market is often driven by headlines in the short term, kind of day to day. But like, man, this first quarter, talk about
Ups
a
and downs.
headline driven market, right? I
Yeah.
mean, it's just day to day, minute to minute. What's going to happen? What are the threats of what's going to happen, and then what's actually going to be followed through with? And it's like you almost feel like you can like pull up CNBC and then you immediately, without even looking at the markets, you just look at like the main headline. You're like, okay, the Dow's probably down 500.
Right.
It was a volatile quarter. The S&P ended down 4.5%.
Yeah, 4.5.
NASDAQ ended down a little over 8%. Now from the highs, a little worse.
But to your point, as volatile as it was, is like bad. Like it really wasn't that bad.
If you ask the average, the average market participant, they would think it was down 20%.
Exactly.
I mean, it was a very heavy, negative, headline-driven quarter. Very little good news. It seemed like within the first quarter. I mean, corporate earnings were good, but nobody even noticed.
Well, it's a tough. We're in a tough spot relative. Specific with the market, right? Markets were at all-time highs, at or right at near all-time highs, and then Trump gets elected and comes in and says, you know what? We've got to make some tough decisions and get some real stuff done here, and we're going to try to make it happen quickly. And so, of course, the market's going to be jittery. Like you would have to expect that. No one likes it. It's not fun necessarily, but it doesn't mean the things that are happening they shouldn't still be trying to get those things done.
Yeah.
It's just a matter of like, it's still, we're wait and see to see if it works and to see what they actually follow through with.
I think that we've ended an era of everything being easy. So for a long time, we've had 0 to 1% interest rates. That's easy. We've had a market that's risen regardless of what news is out there. That's easy. And I think those things can't go on forever, for example, but trillions of dollars of COVID stimulus, 0% interest rates, massive deficit subsidized growth, meaning the government is putting a lot of money into the market, and the GDP is a large percentage comes from the government, which is never a good sign. All of that eventually comes to an end. I mean, you can't continue to have that easy of a situation. So yes, Trump's coming in. He's gonna put the clamps down. I saw something today, the tariffs, and everybody's worried about the tariffs. The actual tariffs are if you take a look at it from a high, the tariffs are less negative to the market than the positive of the regulations being taken out of the economy from the Trump administration, from the Biden administration. Does that make sense? Like the tariffs are the big news story.
Yeah.
But the regulations, taking the regulations out, is actually going to boost the economy more than the tariffs are going to hurt it.
Well, the tariffs
we just talked about tariffs.
It's just the uncertainty around tariffs. I think
Right.
if everyone knew what the tariffs were and what they were going to be over the long term, doesn't mean that the market would just rip higher because now it's known. But I think that would help, because a lot of that could start being priced in and the market would adjust, and then we could kind of move forward. It's just the not knowing.
Yeah.
It's like, saying, hey, we're going to tariff these goods at 50%, and now it's 20, and now we're going to wait. And that, the market, we've said it how many times, like the market doesn't like uncertainty. And that's kind of the definition of uncertainty, is just like when that changes day to day. And so we've got a big announcement apparently tomorrow with tariffs of
it's Liberation Day.
Liberation Day. So, again, personally, I'm a big fan of what they're trying to do. It's just kind of a wait and see in terms of what they follow through with, and is it effective?
Well, sorry. Go ahead.
I was going to say this morning, watching the news, the guest they had on essentially said one of two things is probably going to happen. One is after tomorrow, you're going to see a new world trade. What's the word I'm looking for? A new world trading philosophy.
Yeah.
I mean, it's going to be fairer.
Yeah.
Now it's going to take a few weeks.
Yep.
Or these other countries are going to strike back, and we're going to have a tit for tat for the next several months.
Until those countries go bankrupt.
They indicated that some of the countries that have the most to lose, UK, are starting to get on board.
Yeah.
So it will be very interesting to see, how quickly, if in fact the tariffs go on. Part of me wishes they would. What I don't want to hear is this afternoon Trump come back and say, I'm going to delay it another 4 weeks.
Right. Just either get it going.
Either do it.
Yeah.
Or not. It is this, as Matt said, this uncertainty, this, not knowing when you wake up.
Well, if you look at, volatility is normal. It's part of investing. If you want to make above a risk-free rate of return, you have to take some risk, right? And so if you're taking risk, that doesn't just mean you get a higher return.
Yeah.
That means there's going to be periods where there's uncertainty, your account's down, the market's down, and you get rewarded for being persistent and patient and riding through those periods. And that's what can lead to, and should lead to, the higher returns, is the patience, not just because you own stocks, right? And so volatility is normal. If you go back to 1950, there's been the number of 5% pullbacks in the S&P 500. There's been 71 5% pullbacks, right? So it's basically one a year. There's been 26 times the market's pulled back 10% or more. And so, it just goes to say, like, hey, this is pretty, 10% pullback happens every couple years, every 2 to 3 years.
This is almost necessary.
So,
it's kind of like burning your grass. It makes it sound so silly, but your grass comes back greener if you do that.
Yep.
This is kind of like sometimes you just have to have sell-off in order to get things back in order, in line. And, I was going to say something on how the tariffs are affecting specific companies. I heard a Harley-Davidson story yesterday that I thought was interesting. They have a bike, and I'm not a Harley-Davidson guy, so I don't know these bikes by name or whatever, but there's a specific bike that in the U.S. is $28,000. So that sounds pretty expensive to me. In Belgium, it's over $100,000 because on the proposed tariff situation, if it were to go as is. So that Harley Davidson as an American company will suffer overseas sales because that's going to make that bike unaffordable, right? Mm-hmm. As an example, how tariffs work, that's as it's going right now. If everybody did what they were saying they were going to do on the tariffs. One thing about that, by the way, last thing on tariffs, I know we want to move on. We have taken the brunt of every storm on tariffs. It is not fair. And I like the idea that we're trying to make it fair. I know Trump's brash, and the way he does it sometimes doesn't come out real great. But I like the idea that we're doing this. And I do agree, Lee, I think the first choice there where everybody's going to come to the table is eventually going to happen. And I would bet 6 months from now, we will not be talking about this anymore. There will be agreements already in place. The world will be moving on. Everything will be fine. I'm very hopeful of that, but I think that's going to happen. And then going to your point about the market fluctuating and going down 5%, 10%, all of that is part of the market cycle. And we have been on this runaway train in a positive way for a long time. At some point, the brakes are going to be put on or whatever, and that's what's happening.
Matt or John, one of the things that you talk about, periodically is how expensive the markets have been.
Yeah.
If the NASDAQ had a PE in February of 36, and as of yesterday, the PE had dropped to 24.
But that's awesome to hear.
Still a little bit above average,
right.
But we've taken off 12 points in a month.
And see, that excites me.
Yeah.
Because then the market looks like it's – and now NASDAQ is always a little bit higher.
Sure.
S&P's average around 16 PE. That's a healthy It's never been 16. It's never at 16, but that's what it averaged historically. NASDAQ is always going to be a little higher because of the technology-driven stocks.
But they're just higher margin businesses, higher growth.
Yeah, it's all about the future growth. And I would say that 24 makes me feel really good.
So here's a chart, and we'll have these charts either linked below or on the YouTube video. But here's a chart that shows, time, and we've all heard this, but time in the market beats timing the market, right? And I think moments like this, it's a good reminder of, hey, don't make any major reactions, major decisions or knee-jerk reactions. I'm always telling clients, like, hey, if we're going to do anything, huge if, we need to make subtle adjustments, right? Just to make sure where we need to be longer term. We don't need to get in these big swings of going one way or the other in a big way. So if you go back to 1950, it's all data we've seen 100 times, but if you go back to 1950 and you'd been invested, you had $1 invested in the S&P 500, it would be worth $337 today. Okay, this is data as of yesterday. If you had $1 invested in 1950 in the S&P 500 and you missed the best 50 days out of however many trading days that would be, thousands.
Yep. Going back how far?
To 1950.
Okay.
Yep. You would have $25.
Wow.
So 337 if you would have just stayed invested. If you would have missed the best 50 days, you'd have 25. If you would have missed the best 100 days, you'd have $4. And so what they might you might say, well, that's fine. I'm not going to miss the best 100 days. What we have to remember though is the best days are typically the worst days are typically followed by the best days.
Exactly.
So if you make a knee-jerk reaction, if you make a move after the worst days, which is when you're going to want to make it, you're going to put yourself in a position to miss some of those best days. And you're going to look back and be like, you know what? I was part of the data.
No doubt.
It's just it's inevitable.
I'm a statistic.
So remind yourself of that. If you have to make any adjustments at all, make subtle adjustments, right? Don't get overly aggressive. And this is a good. We need to be talking about these things too when things are going well.
Oh yeah.
Because people don't need to go all in when things are going well, because that's what can get you out of, ahead of yourself.
Some of the biggest mistakes I've seen in investing in my career are both sides. I've seen people when the market's going crazy, and a very conservative investor that needs to be conservative based on their retirement plan. They feel like they're missing out, the FOMO, and they want to go aggressive, and they go aggressive right at the wrong time, at the height of the market, and then they panic, and they get out, and they miss those. To your point, it's emotion. If you take emotion out, S&P 500 does not have emotion.
Yeah.
Right, and that's why it's up $337 because there's no emotion on that trade.
The hardest part of investing, right, the psychological component's the hardest part of investing for sure, but keeping in check the greed and fear with investing is, I would say, arguably the most important part. Way more important than what should you buy, what stocks, what is just managing the greed and the fear. Because as humans, we're going to experience all of it if you've got money invested.
Well, as they say, it's like golf. It's 25% skill and 150% something else.
Luck.
Yeah.
Yogi Berra used to say that in baseball.
Yeah. So a lot going on. I think the point that we're ultimately trying to make here is just, volatility is normal. Don't let some short-term volatility, spook you and make you completely change your plan. If you need to change anything, have an accountability partner, have an advisor, whoever you work with, whatever your process is, and look at, okay, are we still on track? What subtle adjustments do we need to make, if any, that will, ensure that we stay on track regardless of what happens moving forward. And then just put your nose down and go out, enjoy life, and quit worrying about it.
Quit worrying about it. 100%.
And in the grand scheme of things, I mean, to go back to the very first thing we talked about, 4.5%. I mean,
I know.
It's.
I know.
I mean,
I agree.
Go back and look at where we were 2 years ago.
Right.
1 year ago, and so.
Yeah, we've hit all-time highs. I mean,
and most of our clients are fine, and they're not.
Yeah, we're
having
not.
That.
It's not like we've had people panicking.
Correct.
No, it's not. But and maybe this is kind of shame on us, but that's what the media, that's what the news, makes you feel like. But reality is there hasn't been panic. Too much concern. No. So
CNBC. I mean, all the news channels, but especially business channels. There's always a red breaking news banner at the bottom, when in reality, it doesn't rise to the level of breaking news.
No, not at all.
So
I know I watch Fox Business most, and I know you watch CNBC, and I go back and forth. But it's kind of funny. The drama that is created from 24-hour television is just, they have to have drama all the time. But if you listen to every analyst on there, you would think it would be much worse than down 4.5% year to date. And there are people out there, and the other thing confusing for our listeners out there that listen to all this stuff, if you listen to Fox Business or CNBC, every single analyst comes on and has a different opinion. I've heard people say, this is the bottom, market's going to roar from here. I've heard people say, we're just starting the sell-off. And I think you can get really, really lost in the weeds on watching all that stuff. Yeah. And if you just open your quarterly statement and you kind of heard some news, but you weren't watching the market and you're only down 4% because you followed exactly the S&P, you'd be pretty happy.
Yeah. Hey, so last point, I love this data because it's so extreme. So this is same thing going back to 1950, but if you missed the best number of days each year, so this is the best day each year, if you stayed fully invested, your average return would be 8.1% in the S&P 500 since 1950. If you missed the best day of the year every year, so 75 days essentially, your average return would be 4.6%. If you miss the best 5 days of the year, so that's over a 75 year period, the 5 best days of the year every year, your rate of return annualized since 1950 would be minus 4.4%.
Wow.
5 days of the year. So returns cluster, right? Like the returns, the rewards for being invested cluster, and you can't miss that.
And you can't make it up.
If you do, you literally may never recover. So sorry,
I love these. I love this data. It just tells you to not be emotional, stay the course, but also know your number, know what you need to be taking a risk. We were talking before the show started with our awesome producer here, and the fact that this is healthy when the markets go down and all that stuff, and it's all relative to where you are in your life cycle of your investing. If you're a year away from retirement and you're very aggressive, but you don't need to be, this kind of turmoil can really affect you, and it can be bad.
Yeah.
But if you know what you're doing, you wouldn't be fully invested if you're a year away from retirement and you don't need to be.
Yeah.
Makes sense? If you're planning properly, this stuff it won't bother you near. If you're young and the market goes down, you root for it because you're buying more shares every paycheck into your 401k. So,
you know what? One area of the market that's doing well?
Tell me.
Home purchases.
That's good.
10-year, 4.1 mortgage rates dropped. People are
buying houses.
That's good. That's a good sign too.
That data in a while.
Yeah. I know it's been a little bit up and down, but that's
I kind of gave up on it. I was like, no one's ever going to buy a house again.
I know.
Yeah. But we're getting excited because the 30 years dropped to 6.25.
I know.
I mean, for all of us that are sitting here at 2.75 or 3. Yeah. So but it is better for those that are trying to get into the housing market. So
if you want to make yourself disgusted, though, Google the average median home price. And do it for years 2025, 2024, 2023. I feel really bad for the young folks that are trying to get into the market. it's an amazing stat of how high it's gone.
Sure.
Even with interest rates higher.
Sure.
The housing prices are not going down.
Correct.
Which is interesting.
Yeah. Any other things you guys want to mention before we jump off here?
I will say this. We're 2 weeks. We're 3 weeks away from first quarter earnings season rolling out, and so tariffs, no tariffs.
Right.
I mean, literally 3 weeks from now, we begin a 3 or 4 week period of onslaught of Q1 earnings, and so that'll be another sign to see. This will be important to see how strong the economy is continuing to be.
I think
are we going to see slippage? Yeah. Are we going to see some of these major corporations starting to talk about tariffs, starting to say the outlook doesn't look good? I mean, it's going to be a real interesting earnings period this year.
Forgetting tariffs for a second, in general, consumer discretionary is going down.
Sure.
Right, and we've seen that. Like, just even top-end restaurants, it's going down, and our air travel is going down. There's signs of weakness in the economy without question.
So we'll see as we get closer to that.
Yeah.
And one thing I want to mention, everything going on right now with the tariffs, there's, like we've talked about, there's a lot of uncertainty, a lot of questions. And, what I've expressed is I don't know how all this is going to unfold. I don't have a clue. I don't know if it's going to work, if it's not going to work. Trump's going to look like an idiot, or he's going to look brilliant.
One way or the other.
He's going to have to own it. He may not own it, but we're going to need to make him own up.
We'll know and he'll own it. Yeah.
But the reality of the situation is, I think every American, regardless of if you voted for the guy or you didn't, you have to accept the fact that changes needed to be made.
100%.
The trajectory, the path we were on, spending,
100%.
debt, the size of our government was not sustainable. The 100%. Argument about are they doing it the right way, is what they're doing going to work, valid argument, conversation, debate that can be had. But if we can't accept the fact that we weren't on a sustainable path, then you can't really have a conversation.
No.
Right? And
100% agree.
That's where I'm kind of in the wait and see camp. Hey, let's wait and see. I don't have a clue if this stuff's going to work. I don't know about tariffs. Like what?
I do know that government spending is out of control, and so I am all for Department of Government Efficiency. Yeah. I really am.
So I think we give them a chance. It'll work or it won't, and then we'll adjust and go from there. But and I think if it works, the market's going to really like that.
No doubt.
Right?
No doubt.
Now, it might take a while, but the market's going to really like that.
Hey, just remember that we had no deficit in this country when George Bush took over office in 2000. I just think about that for a second. That is not that long ago. Yeah. We had a zero deficit. We had no issues. Reagan and Clinton, with Bush Sr. in the middle there, got us out of debt, with working with both sides of the aisle.
Yeah.
And then it's a shame that we've let ourselves get so out of control now. And so to your point, something has to be done, or we're gonna fall off.
Yeah.
All right. Well, good conversation. It'll be as fun as the first quarter will be. It's today's first day in the second quarter. So
and I apologize for not getting the Mach 1 Navy pullover memo.
Yeah, you're good. We got your back.
Next time.
I'll get in the middle the next time, so it's a little more symmetrical.
We could probably make that happen on there with some fancy editing. Yeah.
All right. Well, as always, we appreciate you guys listening, watching. Give us a like, subscribe, send us your comments and feedback or questions. We'd love to check those out, and we'll see you guys next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.